Bonus depreciation. Seems like December 15th of every year, I get calls from brokers and frantic clients trying to buy a yacht before the end of the year, and also put a charter on the boat on December 29th and qualify for bonus depreciation. It's an interesting subject. So with us today to handle this touchy little subject is Chris Anderson to moderate this panel. He's a partner at Robert Allen Law. Extensive experience in representing a broad spectrum of clients in the yachting industry, including buyers, sellers, manufacturers, brokers, dealers, and marine lenders. He speaks and publishes frequently on legal matters important to the yachting industry. He's a Superyacht. He's also a University of Miami grad. Sorry about that. They did pretty good, though. All right. And he's also a volunteer for the IBA Forms Committee, and he spends countless hours of time working on our IBA forms. So, Chris Anderson.
Good morning. Today we're going to talk about bonus depreciation, and we're very honored to have Glen Stankee here. Glen is a partnerman at Akerman, which is one of the largest law firms probably in the world. He's in their Fort Lauderdale office. He's been a board-certified tax lawyer since 1986. And has been described as the guru of bonus depreciation with yachts. So we're very lucky to have Glen with us today. So bonus depreciation, and we've all heard about it, but just to recap, it's a U.S. tax incentive that it's been around for years, but was made permanent under the One Big Beautiful Bill. To summarize, Internal Revenue Code Section 168K allows businesses to immediately deduct, rather than depreciating the cost over the lifetime of the asset, the cost of qualified property, which in our case is a vessel that's engaged in a U.S. trade or business, in the year that the vessel is placed in service. These are all keywords here that we'll come back to. However, bonus depreciation isn't just a matter of buying a yacht and writing off the cost on your taxes. There are a number of steps and tests that the IRS looks at in order to properly claim bonus depreciation. So Glen and I, we find the intricacies of bonus depreciation to be endlessly interesting, and we can talk about them for hours, but we understand that not everybody feels the same way about the tax code. So to break this down a little bit, we're going to do a little bit of a role play where I'm your typical yacht buyer who's coming in, and Glen's going to advise me on the process. So Glen, I'm under contract to buy a new yacht. It's a new build boat. It's being built by a European boat yard. The vessel is 23.9 meters, and it's being built to CE, which is European consumer standards. The boat is scheduled to be delivered this November, and my yacht broker told me I could take 100% bonus depreciation on the cost of the boat. That's true, right? Am I correct in assuming that, and I can take it this year in 2026, am I correct in assuming that once the yacht is delivered in Europe, the IRS would consider it placed in service?
No, you're not. The vessel isn't considered placed in service just because it's been delivered. Placed in service means a very specific thing. A vessel is placed in service when it's ready, capable, and available for charter. The owner gets to decide when it's available. But to qualify for bonus depreciation, it's not enough that the vessel be placed in service. It must actually be chartered to a third party for fair market value during the year that it is placed in service. This is because of the listed property rules that say vessels are listed property. And that means to qualify for bonus depreciation, the qualified business use, which includes third-party charter use but does not include related party use, must be greater than 50% of the total use. That means that there must be more days of third-party charter use during the year that it's placed in charter service than there are all other uses of the vessel combined. It also means that if you haven't chartered it to a third party during that year, you haven't satisfied that requirement. So we need to have it chartered at least once before the end of the year. Another requirement is that the vessel has to be placed in charter service for the predominant purpose of earning charter profits. If a court were to determine that this vessel is actually the owner's recreational vessel, that he charters from time to time to defray the cost of engaging in that recreational activity, the hobby loss rules will limit the deductions for all charter expenses, including bonus depreciation, to the amount of the charter revenues generated during the year. And that means there won't be a loss attributable to the bonus depreciation that passes through to the owner that he can use to offset other income. And that's the purpose of the bonus depreciation. What you save is the tax that would otherwise be paid on that other income that's being offset by the charter loss.
So one of the requirements of bonus depreciation is that the vessel be used in a U.S. trade or business. Practically, for yacht charters, that means our options are either one, to flag the boat under, to charter the boat under a U.S. flag, which in our scenario, chartering a U.S. flagged vessel in European waters is almost impossible, except under very, very limited circumstances. Or the other option is to put a foreign flag on the boat, bring the boat to the United States, and have the boat available for charter for the majority of the time in the United States, and physically charter in the United States. So, Glenn, since putting a U.S. flag on the boat and chartering in Europe really isn't possible, my plan is I'm going to ship the vessel over to Florida and put a foreign flag on the boat and charter it there. Would that work?
Well, yes. Both foreign flag and U.S. flag vessels qualify for bonus depreciation, but the requirements are different. With a U.S. flag vessel, it'll qualify for bonus depreciation regardless of where the vessel is located. With a foreign flag vessel, it has to satisfy a physical presence test, and that means that it has to be physically located either in the U.S. or a U.S. possession like the U.S. Virgin Islands on more than half of the days during the period that begins when it's first placed in charter service and that ends on the last day of that taxable year. Generally, though, what we would want to do is probably move it to the U.S. Virgin Islands rather than the U.S. And this is because in order to charter a foreign flag vessel in the U.S., it has to first be imported. And the vessel has to be ready, capable, and available for charter wherever you decide to locate it. Otherwise, the IRS would argue that the time it spends there doesn't count in determining whether the physical presence requirement has been satisfied. So if we moved it to the U.S. and wanted to offer it for charter there, we would have to import it. Now, not all foreign-built vessels are eligible to be imported into the U.S. For example, the engines have to be certified as complying with EPA emission standards. But even if it could be imported, it can't be offered for charter unless all the tariffs and the import duties are paid. So most of the time, owners will opt to move the vessel to the U.S. Virgin Islands instead of the U.S. because there it can be offered for charter in a manner that qualifies for bonus depreciation without first having to be imported into the U.S. If you do move it to the U.S. Virgin Islands, you have to comply with the local chartering protocols. They are not terribly onerous, though. You would have to obtain a business license that allows chartering. The only real wrinkle in this is that the USVI, under their charter protocols, require that while the vessel is sitting in the USVI waiting to be chartered, that the crew on board consist of U.S. citizens or U.S. residents. And so generally speaking, what we would want to do is move it there very close to the end of the year. That would shorten the period of time that it has to be located in the USVI. For example, if this vessel were delivered in November, the best option would be to move it to the USVI. If, for example, it gets there by December 1st and is immediately placed in charter service, it means the vessel must be physically located in the USVI on at least 16 of the 31 days remaining in 2026. Now, it does have to be chartered before the end of the year, but that charter doesn't have to originate from the USVI. The vessel could leave the USVI on, say, December 17th. It could be moved to the Bahamas and a charter could be conducted there, and it'll all qualify.
So I find it pretty ironic that the government created this great tax incentive under the One Big Beautiful Bill to allow and make bonus depreciation permanent, including with yachts. And then on the other hand, one of the major requirements is that in order to charter in U.S. waters, that the tariffs have to be paid, which can be, as we said, up to they're currently 11.5% for a European-built vessel. But the sweet spot is the USVI charter. As Glenn said, there are requirements in order to qualify for that USVI charter activity. You have to have the business license. You have to have U.S. crew, and in addition, your boat needs to be commercial and available to charter under flag state rules. So ideally, for our boat that's under 24 meters, that means having either qualifying under the Red Ensign Sport or Pleasure Code, which just replaced the Small Commercial Vessel Code, or Malta, their commercial registry. Those are the preferable options. The less preferable options, as Glenn will talk about, and no offense to our colleagues from the Marshall Islands here, but when claiming bonus depreciation, the private yacht limited charter options that are offered by Marshall Islands or Jamaica make it a little bit more difficult to claim bonus depreciation. So anyway, in our scenario, where our boat is being delivered in November 2026, that's tight timing. If there are problems with the shipyard, they're a month late in delivery. There are significant warranty issues that need to be addressed. You could very well miss that window, and your boat doesn't arrive into the USVI until 2027. So Glenn, what happens if my boat's been delivered, it doesn't make it there into the USVI until 2027? Can I use that boat personally then in 2027?
No, but what I would do in that situation, before I would give up on bonus depreciation, I would consider other alternatives. And one of those alternatives is to put a U.S. flag on the vessel and actually charter it in the Mediterranean before the end of the year. Now, the vessel can't be chartered from the UK or a EU country, but there are places on the Mediterranean where the vessel could be chartered as a U.S. flag vessel. These include Albania, Algeria, Montenegro. There are others as well, but I would look at that as an alternative to giving up on the bonus depreciation. Now, if that isn't possible and you can't get it to the U.S. Virgin Islands in time, then another option would well, if you can't get it to the Virgin Islands, rather than and you can't satisfy the requirements for bonus depreciation in 2026, it would be possible for the owner to defer putting it in charter service until 2027. But this is not an ideal solution, because when you set up the business to conduct the chartering operations, you are going to use pass-through entity structures so that the bonus depreciation or the loss attributed to the bonus depreciation will pass through to the owner so that he can use the charter loss to offset income from other sources. In a pass-through entity structure, it brings into play a number of other provisions of the code that can override and supersede his entitlement to use the charter laws. For example, we have the vacation home rules, and they say that during the year that the vessel is placed in charter service, the owner's and his family's use of the vessel in aggregate must be no greater than 14 days. And that means that if we push the placed in service until 2027, it means he's got to keep his use of the vessel to 14 days or less for all of 2027. That's not going to make him very happy. The best option would be to get it into service before the end of 2026. And then after the beginning of 2027, we can make some changes in the structure that would allow him to use the vessel all he wants personally.
So, say the worst case happens, and I can't conduct a European charter in 2026. The government was shut down. I couldn't get a certificate of documentation before the end of the year. So in order to get around that 2-week limit on personal use that you just described, can I take my boat on a 3-week charter, a shakedown charter, where I'm just making sure everything's in order, all around the BVIs? Would that work?
Well, notice the chuckles that you get by proposing that. Anytime the owner is on board the vessel, it's going to be treated as a day of personal use, unless he's on board the vessel solely and exclusively in furtherance of the chartering business. He doesn't avoid these rules by having his company sign the charter agreement or pay the charter fee. These rules still apply. So if there's more than 14 of those days, the vacation home rules are going to limit the deductions for all expenses. Now, a shakedown cruise obviously does further some business use, but the IRS would very likely argue that this is a dual purpose use of the vessel. It has a business purpose, but it also advances personal purposes. And if that's the case, it's a dual purpose. And if it's dual purpose, it's going to be treated as personal use. So you don't avoid it. Now, this is particularly true if he brings people on board with him that have no role in the management of the chartering operations. They're there just for entertainment. And that clearly would be treated as a day of personal use. So it's not an option, in my view. But you'd be surprised how many owners have made this exact proposal to me and asked me to
every
bless
time.
it.
So Glenn, one thing I don't think we touched a little bit on was the difference between chartering under a commercial registration or a private yacht limited charter registration that typically limits charter to 12 weeks a year. Can you explain the differences and the implications of that on bonus depreciation?
Well, the owner has to be very sensitive to any limitations that the flag state imposes on the number of weeks the vessel can be chartered. Because as I pointed out, the chartering has to be conducted for the predominant purpose of earning charter profits. If he subjects it to limitations, chartering, say, for 12 weeks, he has to be prepared to demonstrate that he can earn a charter profit with 12 weeks of charter. If he subjects the vessel to fewer weeks than it takes to generate a profit, then that would be very compelling evidence that he didn't have the requisite profit motive. And the IRS could use that as a basis for disallowing the bonus depreciation allowance.
Okay, so say we meet these requirements, right? We're able to conduct a charter in 2026 under a U.S. flag, or we make it to the USVI and we meet all those use restrictions. Is that all I have to do in order to qualify for bonus depreciation? Can I write it all off at that point?
Well, there you've satisfied the requirements. I mean, if you have physically located it in the USVI and you've avoided the rules like the vacation home rules that can override his entitlement to the bonus depreciation, the vessel will qualify as long as it is actually chartered to a third party for fair market value before the end of the year. But we have to be very careful going forward. If we were to keep this vessel in the same pass-through entity structure, and then in any subsequent year after the year that is placed in charter service, the third-party charter use drops to 50% or less of the total use, the listed property rules would require that he recapture the bonus depreciation that he claimed in an earlier year. That would be a real disaster because he hasn't sold the vessel and he's got to come out of pocket for all of the tax liability that's incurred by reason of that recapture. To recapture just means to take that same amount and include it in income, and it'll all be included as ordinary income. So 37% of whatever that bonus depreciation amount is becomes his tax liability in a year after that first year if the third-party charter use drops to 50% or less of the total use. But we can address that. If we were to make a check-the-box election to classify the domestic LLC that he has in his chain of ownership as a C corporation, we believe that that cuts off the obligation to recapture the bonus depreciation that he claimed individually prior to making the election based on how the corporation uses the vessel. There's nothing in the code that ever requires the corporation to recapture depreciation that was claimed by the shareholder prior to the election until the vessel is actually sold. There's nothing that imposes that obligation based on how the corporation uses the vessel. Now, no court's ever actually addressed this issue, but I was involved in an audit where the IRS had argued that the recapture taint follows the vessel into the hands of the corporation, and that if the corporation's third-party charter use drops to 50% or less of the total use, that the corporation has to recapture it. But the IRS conceded the issue. After we made the argument, they conceded that that is not what the code provides. And so we don't have any authority on it, but the IRS seems to agree with that position, and we feel very comfortable that if they claimed that the corporation has to recapture the depreciation the individual claimed based on how the corporation uses the vessel, that they would lose.
So Glenn, I think one item we still need to address is active versus passive income. If I get the boat into charter, are there any other requirements that I need to know about before I can take this against my active income that I'll have in 2026?
Well, you raise a good point. Passive activity loss limitations have to be dealt with. Basically, we have to look at the type of income that the owner wants to offset with the charter loss that's attributed to the bonus depreciation. If it's active business income, then the charter loss has to be an active business loss. If it's a passive loss, it can only be used against passive income. If the owner has no passive income, he can't benefit from the loss. So whether or not the charter loss is an active loss or a passive loss depends on whether the owner can satisfy one of the material participation tests. He has to materially participate in the activity. If this is a large vessel with lots of crew living on, he's probably going to have to satisfy the most stringent test. And that is, he's got to be able to show that he devoted at least 500 hours of time to the activity during the year that it was placed in charter service. If he's married, he gets to combine his wife's time with his own, and they just have to have 500 hours between the two of them. Now, the issue that typically comes up is, when do we start counting the hours? But if he and his wife can demonstrate a particular date on which they decided to engage in the chartering business together and share the profits and losses from the activity, that would start the period of time from which all of the time they devote to the activity should be counted as participation in the activity and should be counted in applying the material participation test. And that would mean that the time they spend going to the boat shows and looking at vessels, all that time should count. Now, normally the travel to the boat show would be considered commuting time and wouldn't be counted. But if the husband and wife are both involved in the management of the business and they travel together, then the whole trip, they're talking about the vessels or the chartering operations, that makes it participation time. We have management strategy sessions on board the plane, and that means the commuting time is all counted. So generally, when we have a material participation issue, we want to make both of them involved in the management of the activity, so that the time they just spend talking about it between themselves all counts as participation.
So that's our brief overview of bonus depreciation. I mean, we can keep talking if you guys if you guys want. But are any questions out there? Iona?
Hello, Iona Hernandez from the Marshall Islands Registry. One part of the subject that I don't think was covered, you mentioned that for foreign flagged yachts to be able to participate in this program is that they have to be commercial vessels chartering in the U.S. Technically, that's not allowable because of the Passenger Vessel Services Act, the Jones Act. Can you kind of cover how you get around that?
Yeah. So I mean, the USVI is one of the main routes, right? Not only does your your vessel doesn't need to be tariff and duty paid because it's outside of the U.S. Customs territory, but also the Jones Act, and sorry, I apologize, I said it.
Yes, sorry. I brought it up first.
It doesn't apply in the USVI. So commercial charters are allowed in USVI waters.
But it's my understanding most of the yachts doing this don't only do that. I've been told some use bareboat charter agreements and those type of things. So I was kind of hoping that you would elaborate on that, because U.S. bareboat charters are also kind of, in my opinion, a little questionable in terms of a true bona fide bareboat charter. And how you get around that with it having to be commercial.
So we'll let Glen get into that, but the certainly it's assuming that your owner pays the duty and tariffs, or if your vessel, if the vessel's already duty and tariff paid and you preserve that status, then the vessel can under certain flags conduct bareboat charters in U.S. waters. Now, Glen, you want to talk about how that looks to the IRS?
Be considered commercial activity, though?
Well, yeah, it is commercial activity, even if it's a bareboat charter. The tax law doesn't distinguish between fully crewed charters and bareboat chartering. It has to be a commercial activity, but bareboat chartering is a commercial activity. But here, even though it's if the vessel can be chartered while it's under a private or pleasure or recreational endorsement, that's sufficient. So it could come into the U.S., and you're right, a foreign flag vessel has to be chartered in the U.S. only on a bareboat basis, but that qualifies for bonus depreciation.
Thank you.
Hi, the tax codes are, I think, purposely obfuscated and I guess open to interpretation. And I'm wondering how much, and you brought up a case where some of this was tested. Big question being, active versus passive. That seems to be the one that catches most people up. And is it possible, is there any scenario by which there is a defendable 100% participation by the owner?
Well, the guidance that's available in this area is extremely limited, and almost none of it applies to charter vessels. Like the vacation home rules, for example, they generally apply to condos that the owner stays in sometimes and rents the other time. What we have to do is take that law and try to make a determination of how the court would apply that law in a charter vessel situation and see if there's any facts that we could still cause to be in existence that would tip the scales one way or the other. But we've had bonus depreciation now ever since 9/11/2001. It's only applied to new vessels until 2018. Then it was expanded to include used property as well. It's not limited to vessels, though. Bonus depreciation applies to any tangible personal property used in a trade or business. The percentage of the total population of assets eligible for bonus depreciation that consists of charter vessels is insignificant. It's not been a high enforcement priority. And, so there's very little guidance out there. But as we get through more and more years, we get more comfortable with our prognosis of where the court's likely to go with this issue if it ever does come up. And I've had the opportunity to participate in audits of chartering operations. Fortunately, myself, I've never had one actually challenged by the IRS that I've designed, but I get called into other audits. And as we go along, we get more and more opportunity to sort of skew the direction of the law one way or the other. And it's all being done at the national level of the IRS. They will determine an institutional position on a particular issue. For example, I had one case where the argument that the IRS made was that even if you had a U.S. flag vessel, and there's a ruling out there that specifically says that if you have a U.S. flag vessel, you have subjected it to the jurisdiction of the U.S., and by subjecting it to that jurisdiction, you've made it part of the foreign and domestic commerce of the United States. Well, despite that ruling, the IRS argued that the vessel still had to periodically come back to the United States from time to time to be part of the U.S. commerce. And we convinced them that if they litigated that, they would lose, that it's enough that it just be flagged U.S. And so they conceded the issue, and they conceded it at the national level. So I believe there's a high level of confidence that if this has a U.S. flag on it, it can qualify for bonus depreciation regardless of where it's located. But the law is still being developed.
Not a lot of case law out there. Not a lot have been reviewed, which I think is maybe a good thing, but also, double-edged sword. Is there any provision that allows the owner to look back in this new big beautiful bill provision? Back in 2016, they used to be able to look back up to 2 years, I think, and revise or redo the previous year's returns based on bonus depreciation?
Well, the statute of limitations on the IRS's ability to challenge a position that the taxpayer had taken on a return is 3 years. And so generally, we want to make sure we've dotted our I's and crossed our T's for that 3-year period following the date on which the taxpayer filed his return for the year in which he claimed bonus depreciation. The IRS hasn't challenged it in that time, it's gone. You don't no longer have any risk of losing the bonus depreciation. And that's why generally we tell the owner that for at least 3 years after he's filed that return, that when he uses the vessel, he uses it pursuant to a charter agreement that provides for a charter fee that can be defended as fair market value. Now, normally there's no economic significance to that because he's going to be paying money in anyway to the extent that he's got cash operating expenses in excess of third-party charter revenues. That's going to be a cash operating shortfall that he's got to make up. So we would have him or his accountant project what that amount's going to be over the course of the next year and determine how much time that gives him on the vessel if we were to treat that amount as a charter fee that he pays at the same rate that the third parties pay. It gives him all the time he wants on the vessel. We don't have to discount the rate. But if, for example, that entitled him to 6 weeks on the vessel and he wanted to use it 8 weeks, then we would use a block charter agreement that would be designed to justify a discount in the rate he pays. And the idea is that anybody who's committing to 8 weeks of charter in a single year is going to get a much lower weekly charter rate than somebody who only charters it for a single week. So the goal is to give him all the time he wants on the vessel for the money that he has to pay in anyway, but to do it in a way that protects the bonus depreciation deduction that he took in the earlier year and the deductibility of the expenses going forward. Because even after that 3-year period, we would want him to use it pursuant to a charter agreement and treat the money he puts in as charter fees to protect the deductibility of the expenses. Because if he's treating it as his own personal vessel and not observing the formalities of dealing with the corporation at arm's length, the IRS would disallow all expenses attributable to his use and a proportionate share of all expenses that are attributable to idle days when the vessel just sat at the dock with crew on board. And when you disallow all of those expenses, you'll probably turn a very substantial economic loss into a very substantial taxable profit that the corporation will have to pay tax on.
Okay, we've taken the 100% depreciation, right? 5 years later, the boat gets sold. Let's say it gets sold for $10 million. What is owed on taxes? What's the tax base?
Well, it depends on what you do with the proceeds, but if it's in a corporation now and you've reduced the basis in the vessel by the 100% bonus depreciation to zero, it means substantially all of the sales price is going to be taxable gain. It's in a corporation, so that tax rate at the corporate level is going to be 21%. If you kept it in the pass-through entity structure, it would be 37%. Now, if he were to distribute those proceeds out of the corporation to himself, then the amount that gets distributed is what's left of the sales proceeds after the corporate tax has been paid. If you did the math on that, you would see that the combined tax rate at both the corporate and shareholder level will be 37%, which is what it would be if we kept it in the pass-through entity structure. But in a corporation, he's got a number of options available to him. For example, one option would be to buy, if he wanted to use the proceeds to buy a new vessel, he could acquire the new vessel inside that same C corporation, use the bonus depreciation on the new vessel to offset the gain that the corporation realizes on the sale of the old vessel. He could keep doing that for the rest of his life and never come out of pocket to pay taxes. But generally, the owner will find it to be more beneficial to bite the bullet on the 21% corporate tax distribute the proceeds out, and acquire the new vessel in a new pass-through entity structure. He'll use the bonus depreciation on the new vessel to offset the shareholder level tax that's imposed on the distribution. But if that leaves enough left over that he can use against income that would otherwise be 37% taxed, that'll be a much better result than if he applies it against corporate income, which is only taxed at 21%. And particularly if the corporation has no other income other than the gain on the sale of the old vessel. There could be a lot of bonus depreciation that's wasted that way. But that's a decision he can make at the time he sells the vessel.
All right. Thank you, Glenn.
Thanks, Chris. Thanks, Glenn. Can we get our other panel up here, please?